Hello and welcome to the TPO Bootcamp. My name is Bradley Haven and I am the owner of the Trade Vets. I'd like to congratulate you on taking the first steps towards converting your time into value. We at the Trade Vets are committed to assisting traders in understanding what it takes to achieve financial independence and build a community of like-minded individuals. This bootcamp is intended to provide you with the tools you need to begin your journey towards financial freedom. The bootcamp is not intended to teach you when to buy or when to sell, but rather to teach you how to identify those areas by tracking value rather than price. It is crucial to note that no class will turn you into a successful trader. It takes time to become what I refer to as a risk manager. Nothing beats the time and experience that it will take, as you hear repeated throughout this bootcamp. Hard work beats talent when talent doesn't work hard, as a great coach Tim Nioki once said. I truly believe that anyone can learn what it takes to be a risk manager and understand the profile, but the problem is that too many people try to run before they can even roll over. Before we begin, I'd like to thank Jim Dalton and J. Peter Stallmeyer for bringing the profile to light. To get the mind thinking creatively, we'll start with a story. To comprehend the market, you must engage the analytical and creative parts of your brain. In my early adolescence, I met a family with the surname Curtis, which was appropriately named because they were some of the most courteous people I had ever met. After seeing the father of the family at home several times during the day, which was atypical for me because my parents mostly worked and I normally didn't see them till around dinner time, I inquired what he does for a living. Mike Curtis, the family's father, ran his own construction company. I discovered that the sons would also work there during the summer vacations from school. I asked if I could also work there because I was interested in learning and saw it as a way to make an income. I had no true passion for construction, but the thought of one day working for myself resonated deeply inside of me. They took me to a hardware store and bought me a brand new tool belt, a hammer, chalk line, pens, tape measures, and a 4-to-1 screwdriver, all on my first day of work. I felt that I was ready to take over the world, as if I could use these tools to pave my way to success. There was only one problem. I have no idea how to use any of these tools. Of course, not knowing at the time that it is not the tools that allow one to successfully build something, but rather the knowledge on how to use them. I was then led to a job site with my brand new tool belt, shown a trash pile, and instructed to load it into the back of the truck for a dump run. Okay, I thought, maybe I'll use the tools later today. We went to a waste facility, dropped off the trash, and then went to another location to do the same thing. On day 2, I was back at the warehouse painting raw materials before they were delivered to a job site. Once again, I found myself wondering when I would put these tools to use. The following week, I am on a job site delivering materials when a foreman calls me over. I am overjoyed. I dash back to the truck, quickly strap on my tool belt, drew my hammer from its sheath like a knight from a sword to battle, only to be given a shovel and told to dig a hole. I was disappointed because I thought I was about to build the Colosseum. At the end of the day, I asked Mike, the owner of the business, who is also my friend's father, when are we going to start building? He smiled at me and said, you'll get to build when you are ready, but first, you must learn to dig. Some may be put off by that thought and how long it takes to learn how to build a structure, but not me. I promised myself that I would dig the best footings anyone had ever seen, and that they would also pass inspection on the first try. I also told myself that if I didn't dig the highest quality footings, the structure would collapse. So there is no structure without the footing. I had set a goal for myself that by the end of summer, I would be doing so well that they would want to start teaching me to build. When summer came to an end, I was never asked to build anything. Mike taught me an early lesson, perhaps inadvertently, that even with all the tools in the world and knowing the boss, I still don't know how to build a structure. Also, that every structure is built from the ground up, which takes time. It appears to be simple and methodical. I'm sharing this lesson because I want to remind you that understanding a new way to look at the market takes time. Apprenticeship programs for carpenters typically last 48 months, require 4,800 hours of work, and 612 hours of technical classroom instruction, mastering all of the tools in their toolboxes. I want you to understand that it is natural to want to use your tools with very little knowledge, or in this case, be in a trade. But initial observation and experience is required to be successful and consistent in the long run. In 1963, J. Peter Stoudemire joined the Chicago Board of Trade. In the early 1980s, he founded the Market Profile, trying to increase the transparency for offshore traders and attracting new traders to the exchange. Using the statistical bell curve, Peter Stoudemire created a system that displays market trading data and activities during the trading session. In his most recent work, he relates the continuum to the process of distribution. His most recent research indicates that the market's ultimate common denominator is a balanced distribution. In other words, a bell-shaped curve. Peter published the CBOT Market Profile Guide in 1985. The link for the guide will be below this video. Although the market profile has evolved since the 1980s, the fundamental principles have not. In 1987, Professor Thomas P. Drinka launched the first market profile course. 1991, the CBOT Market Profile Manual No. 2 was released. The profile is still used by professional and retail traders today. If this is your first time viewing the market profile, this image may be perplexing. You may be accustomed to using bar charts or moving averages and oscillators. This will be your tool belt, and the tool you will use to gain an understanding of the market. For the sake of brevity, the profiles we'll be using throughout this bootcamp will be based on the E-mini S&P 500. The profile is understood, it can be used in any market. I chose the examples in this bootcamp to show you what to look for as you continue your journey to become a risk manager. Remember that each day is unique, and as you observe more, you'll become more in tune with the market. The market profile is a graphical representation of the auction market process based on data supplied by the market. During the auction, the structure reflects the thoughts of the participants. Price is expressed graphically on the vertical scale, whereas time is shown visually on the horizontal scale. The finished profile describes what occurred, when it occurred, and who was involved. Because the market profile is a tool instead of a trading strategy, interpreting the market profile data requires an understanding of concepts rather than just memorizing rules. Those who put in the work, however, will benefit from a newfound ability. The focus of this bootcamp is on learning the market profile idea rather than specific trading techniques, since we found that once traders understood the concept, they were able to create methods that were a good fit for their own trading styles. Each letter stands for a period of 30 minutes and proves that at least one trade occurred at a certain price during that time. The end-of-day distribution curve reveals the range of prices throughout a particular trading session. Time price opportunity, often known as TPO, is the most fundamental component or building element of the market profile chart. As soon as the market reaches a certain price at a particular moment in time, a time price opportunity is produced or written on the chart. Simply said, a time price opportunity is a window of opportunity for a deal at a certain price at a certain time. The print is made on the profile chart after a single deal is executed at this market opportunity. The profile will still only print a single TPO for that opportunity during a defined time frame, even if several transactions occur within that same time. A TPO only notifies that at least one transaction occurred at a certain price within a predetermined window of time. There are several methods to graphically portray a TPO on a profile chart. It may be as simple as a single colored block or an alphabetical letter. TPOs are often shown on profile charts using an alphabetical letter. Each TPO print has a pricing ladder in front of it that shows the variety of costs. As you can see on our profile here on the left, all of the letters are just representing each 30-minute period of time, and as time goes on, they will overlap each other and form a distribution curve. The range of price movement that takes place during the first hour of trading for the day is referred to as the initial balance. It consists of the first two half-hour intervals. The first two letters, A and B, produce a range of price fluctuation, which is the initial balance. The initial balance may often provide us a wealth of crucial hints about the expected trading range and changes in the profile structure for the day. On many days, the initial balance period is when the real high or low is made of the day. Keep an eye on and note any further price changes throughout the day in relation to the initial balance period. The price range will widen in the direction of the trend when the market is going in a particular direction. The first price range will rise and expand over the initial balance if the market is optimistic. If the market is bearish, however, the price range will fall below the initial balance. It is quite likely that the range will move to one side to the other. If the day begins with a reasonably modest initial balance range, however, if the day begins with a broad initial balance range, one of three potential outcomes will often play out. A directional day or trending day will be created by the market continuing in the move in the same direction of the opening range. So, let's say the market opens up here, moves lower, but then auctions up. If C period were to open up and continue to auction, and D period open up and continue to auction, that would be situation 1. Situation 2. It's possible that neither side of the broad initial balance will see any growth. In other words, the day's high and low will be identical to those of the first two periods. The initial balance range will hold all of the day's activities. So in this situation, the market opens up here, auctions down, and then auctions up. C period opens up and auctions inside B period. D period opens up and auctions inside the A and B period. E, F, G, H, and so on. And all of the day's price range is captured inside the initial balance. The third scenario, the market actually somewhat widens the first range highs or lows. Prices may really go above the high and below the low of the initial balance on certain days to test the market. For each trading day, the initial balance is a crucial time frame. A trader should carefully watch, note, follow, and research the initial balance information for the instruments that they trade, as they will be different for each instrument. There will be able to differentiate between the day's broad and narrow initial balances thanks to this. Naturally, these initial balance ranges will vary greatly depending upon the kind of financial instrument. The price range that emerged from the first two periods of market activity, the principle, is more crucial than the definition, which is that it will be simpler to topple or experience range expansion when the starting base or the initial balance is narrow. A larger initial balance will be more stable and capable of keeping prices in check. Some days have no initial balance since the market tends to trend right away from the opening range while continuously expanding its range. So we need to remember a wide initial balance, oftentimes, unless the market starts to trend, will contain our entire profile. Whereas a narrow initial balance, most times you get tests on either side of the profile. Price changes that expand a range are referred to as range extension. A price range may be increased or decreased as the market auctions. Often a range expansion might provide us with some clues about the market's likely course. Prices that have extended upward might be a sign that the market is positive. A bearish market mood might be indicated that if prices move to the downside and extend lower. There are a number of potential outcomes for the price range of each new period as the market auction process progresses from one to the next. The increased time range might initially only be encompassed within the earlier time period's range. In this instance, a defined value region is where the market is consolidating. The traded price range may also increase in the next period, extending the range of the previous period upward. An upward extension indicates that buyers are in charge. On the other side, the price range may potentially dip below the low of the previous period. This suggests that throughout the new period, the sellers are in charge. The price range might possibly widen both above and below the range of the previous period. Price range extensions of this kind that go beyond the high and below the low of the range of the previous period are a sign of volatility and uncertainty in the market, and possibly about a potential change in direction going forward. On the other hand, the market is indicating that it is not ready to depart from the present price range if there is no range expansion above or below the range of the preceding period. This may just indicate that the market is taking a break before continuing in the direction of the current trend. Or it could really indicate that the market is going through a transitional phase before changing. So some examples here, as you can see, you have A period moving higher, you have B period moving higher, and C period is captured by this B period. And then D period gets range extension above this C period and above the B period, indicating that buyers are in control. And then once again, E period does the same thing. F period is completely encapsulated by E period, initiating or showing us a balance. Then G period opens and auctions lower, taking out both the F and the E low, indicating that to us that most likely sellers are in charge and the market is now looking to move lower. The market moves lower. H period continues to extend to the G low, but back inside of the range. I period trades inside H, and that indicates that the market is balancing and often can signify the end of a trend. J period moves higher. K period takes out the low and stops right at the high of J. L period extends up and M period extends up, indicating that buyers have once again retaken control in this area. Price changes that expand a range are referred to as range extension. A price range may be increased or decreased as the market auctions. Often a range expansion might provide us with some clues about the market's likely course. Prices that have extended upward might be a sign that the market is positive. A bearish market mood might be indicated that if prices move to the downside and extend lower. There are a number of potential outcomes for the price range of each new period as the market auction process progresses from one to the next. The increased time range might initially only be encompassed within the earlier time period's range. In this instance, a defined value region is where the market is consolidating. The traded price range may also increase in the next period, extending the range of the previous period upward. An upward extension indicates that buyers are in charge. On the other side, the price range may potentially dip below the low of the previous period. This suggests that throughout the new period, the sellers are in charge. The price range might possibly widen both above and below the range of the previous period. Price range extensions of this kind that go beyond the high and below the low of the range of the previous period are a sign of volatility and uncertainty in the market, and possibly about a potential change in direction going forward. On the other hand, the market is indicating that it is not ready to depart from the present price range if there is no range expansion above or below the range of the preceding period. This may just indicate that the market is taking a break before continuing in the direction of the current trend. Or it could really indicate that the market is going through a transitional phase before changing. So some examples here, as you can see, you have A period moving higher, you have B period moving higher, and C period is encaptured by this B period. And then D period gets range extension above this C period and above the B period, indicating that buyers are in control. And then once again, E period does the same thing. F period is completely encapsulated by E period, initiating or showing us a balance. Then G period opens and auctions lower, taking out both the F and the E low, indicating that to us that most likely sellers are in charge and the market is now looking to move lower. The market moves lower. H period continues to extend to the G low, but back inside of the range. I period trades inside H, and that indicates that the market is balancing and often can signify the end of the trend. J period moves higher. K period takes out the low and stops right at the high of J. L period extends up and M period extends up, indicating that buyers have once again retaken control in this area. Excess signals the conclusion of one auction and the start of another. It is apparent throughout the two-way auction process by buying tails and selling tails. Excess happens in all periods. There are also numerous two-way auctions running. One may be finished while the other is still live. Excess happens in all time frames also. To fulfill its main purpose of trading facilitation, the market auctions lower to find buyers and higher to attract sellers. Ideally, the market will discover a value in which both the other period buyer and seller view the price to be fair, allowing for two-sided trading. However, the market is effective rather than efficient. As a result, in its endeavor to generate trade among all players, the market periodically produces a surplus by auctioning too far in a particular direction. Excess is visible at the tops or the bottoms of the profile, indicating the conclusion of one auction and the beginning of a new one. On a candlestick chart, excess is represented by a 30-minute candle with a lengthy wick. The buying or selling tail in the other term for excess. A buying tail indicates that responsive buyers are jumping in below value. A selling tail indicates that responsive sellers are jumping in above value. The longer the tail, the more convinced buyers and sellers are. Generally, excess is seen in the extremes of the profile. As you can see here, we would classify the excess of the profile as the high and the low, right? So you have this excess to the high and you have your excess on the low. And we can assume that nobody wanted to sell the price down here and buyers stepped in, and nobody wanted to buy the price up here and sellers stepped in, which caused the market to rotate back to the mean, the fairest price, which is the point of control. Responsive buyers are long-term traders who are drawn to the market when they spot a good deal. As the initial range falls to the level that is appealing to these long-term traders, they will swiftly move in and purchase at these lower prices. Just as customers may leap onto discounts for things at the store. When this occurs, the market declares that the range has been identified where prices are regarded unfairly low. Buyers immediately accept and seize these cheap prices, resulting in a single print buying tail. A buying tail suggests that active buyers are present in the market and price level at that moment. The larger the deal, the longer the tail. Although a single print may be called a buying tail, a tail with a single TPO does not have the same weight as a lengthier buying tail. The longer the tail, the more certain the buyer was at purchasing prices at this level. The market will regularly revisit these discounted levels to see whether buyers are still active and as excited or willing to purchase as they were before. You can see here that's represented by these single print TPOs down at the low, where buyers stepped in at these low prices. When the price range hits the price region where prices are rejected by the market, participants are thought to be at an unreasonable high. Sellers will gladly join the market. Sellers will be ready to supply the market and sell as much as they can at these high prices. The seller's strong reaction causes a selling tail. The same size requirements that apply to the buying tail are the same for a selling tail. The longer the tail, the greater the relevance. The market will also regularly return to test these levels of unfair highs and lows. The future presence of sellers at these levels will be determined by market circumstances. Because the market is always shifting, these levels will undoubtedly be challenged at some point in the future. So we can assume that a seller has entered the market here, even though we only have 2 ticks and we wouldn't qualify this as good excess, and that'll be something we'll get into later in the class. Right now, the focus is just identifying these key elements. But we can assume that a seller has entered the market at this level, and this will be a level that the sellers will hold longer term. Value area. This is where 70% of the day's business is conducted. Key references for the value area are the ones we've talked about before, the value area high and the value area low, representing the first standard deviation of the distribution of the profile. The point of control is also encapsulated inside the value area, which is the fairest price of the day, or the spot where we have the widest part of the profile, where the most business was conducted and the most time was spent. The key here is to note that during the profile, or while you're watching the profile, inside the value area is going to be where most of the trades will occur, and you'll get the most two-sided trading. Single prints. A single print is a single column of activity in a single region or segment of the profile chart. A single print may be composed of one or multiple TPOs and can appear at the top, middle, or bottom of the profile. When it occurs in the profile structure, however, it is characterized as a negative development or just a single print. Single prints are important structural features on a profile chart because they highlight price levels in the market when the long-term traders displayed strong buying or selling activity. These aggressive levels of engagement offer us information about the market attitudes of long-term investors. Furthermore, depending upon the sort of activity engaged, the price levels where this activity happened ultimately becomes reference levels as either support or resistance. So we can see that on the low of the profile, we have some single prints. And on the high of the profile, we also have some single prints. And in the middle of the profile here, we have some single prints representing that there was most likely a liquidation in the market. And this area will most likely act as resistance until value is able to move back up and build in this level. A lot of times these can be volatile movements, and you'll see very rapid movement leaving these single prints behind. And that is because there's trapped inventory above in this situation that causes them to run for the hills, so to speak. And we'll talk about that a little bit more when we get into the auction process in the later part of this class.